Welcome back to Squawk on the Street. It is now time for our ETF Spotlight. We're checking in on the Spider S&P Bank ETF, ticker KBE, getting a boost this week as financials continue to outperform amidst a rise in yields. Goldman Sachs, Morgan Stanley, and Wells Fargo all hitting 52-week highs this morning. So here with more on the space, or on the sector, I should say, is RBC's Gerard Cassidy. Gerard, great to have you on this morning. I just want to get your thoughts. I mean, as we have seen the 10-year yield move higher this week, is that really what's powering these stocks right now, or are there other forces at play as well?
No, I think you put your finger right on it. We're definitely seeing the steepening of the curve be the real catalyst. You might recall at the start of the year when the 10-year was down well below 1%, and it steadily rose through into May to about over 170 basis points, and the bank stocks did extremely well. And that trade from growth to value was very strong, and the banks benefited from that. But once rates peaked and started to come down, the banks started to struggle. And as you just pointed out, now that the 10-year is moving back up, the banks are moving up with it.
So I realize they're probably still a few months away from the beginning of taper, but given the fact that we are getting more Fed speak and more talk of it right now, is that a good thing for banks? And if so, is it a situation where they tend to rally alongside that talk, or is it something where you wait and watch and see as an investor?
I think it's a good thing for bank stocks. The steepening curve enhances their net interest margin, and higher net interest margins will lead to greater revenue. And so if we see a 10-year toward the end of the year approach 2% rather than 1%, the bank stocks will do well. In addition to that, the underlying fundamentals, as this economy is growing, as you saw the employment data recently, as well as this inflation data that came out today, this is all beneficial for the bank's underlying fundamentals, which will drive the stocks higher as well. So we could potentially have two forces here over the next 12 months, which is higher rates, but also increasingly stronger fundamentals coming from increased loan demand.
Yeah, let's dig into that a little bit more, because I know you wrote on this not that long ago, but the loan loss reserve releases and what that did to power gangbuster earnings for the biggest U.S. banks in this earnings season. I mean, these are also institutions that are sitting on a lot of excess cash right now. So how does that get deployed? And if it does, whether it's loans or securities, what does that do to continue to power those EPS numbers?
You're absolutely right. The liquidity and the level of securities ownership at the top 20 banks, or for the banking industry for that matter, are at record levels. One of the measures we use is called the loan-to-deposit ratio, which measures how loaned up the industry is. And it's at record lows today at around 59%. Normally, it should be closer to 90%. So what you're likely to see, you don't even need to really see the Fed raise short-term interest rates for the banks to benefit. All the banks will need to do is loan demand increases, as we think it will, based upon the history of this country and the need for loan growth to support economic growth. All the banks need to do is transfer the assets, their earning assets, from securities that are yielding less than 2% to loans that are going to be yielding 3 to 4%. And that's a pickup in revenue just from transferring the assets, which we see happening. Then if you do see the Fed have to raise short-term interest rates in 2022, that's just added fuel to the revenue growth and earnings growth for this industry.
Hey, Gerard, I wonder, as we're looking for areas where there's more gas in the tank on some of these names, maybe it's loan growth, but I wonder how much is in continuing loss provisions, perhaps discussion about capital returns?
Sure, hi, Carl. Well, what I would say is that the loan loss reserve releasing, as you might recall, last year at the height of the pandemic, the banks had to set aside hundreds of billions of dollars in loan loss reserves. And we didn't have a credit cycle. Carl, this is the first time in our careers that we didn't see a credit cycle. And it was because of what the Federal Reserve and the federal government did. And the outcome was the banks did not have any material credit losses. Now they're releasing that back into revenue. We're probably seeing the peak of those numbers. We expect it to continue into the second half of next year, but it just won't be at the size of what we just saw. But you brought up another good point, the capital action plans. The capital action plans for the banks are going to be very strong. You've seen all the big banks announced dividend increases following the stress tests that they went through in June. You've also seen sizable buyback announcements. So not only do you get the underlying fundamentals, the potential for rising rates, but you have these capital action plans also going in favor of shareholders to own the stocks today.